Hello, and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me again is Pepperstone's Senior Market Strategist, Michael Brown. Hello, Michael. Well, broad overview. Stock market's pretty meh, looking a little bit soft this week. Once again, it's Trump, China trade and trade in general that appears to be driving the narrative here.
Yeah, very good afternoon to you, mate. I think you're absolutely right on that one. It very much is a case of just some very modest softness coming in, a few jitters around the trade front once again, and also some geopolitical concerns in the mix as well. And I think perhaps the market just lacking a little bit of conviction to push higher still, especially ahead of what is a busy old week next week in terms of central bank meetings with of course, the Fed on Wednesday, which we'll discuss momentarily.
Yeah, obviously on Fed Watch, also on BOJ Watch, Bank of England Watch, and SMB Watch. So, as I say, a fairly big week on the macro front. But before we get started, we've got quite a bit to get through today. So I'm going to list the topics, and then I'll obviously do the risk warning so that people have a fair idea of what's on the agenda for today. And we're going to be focused domestically as well as internationally. Obviously, more bad news from the London Stock Exchange this week with the news that AlphaWave is joining the exodus from the London market, snapped up by Qualcomm. So we'll talk about that. Elon Musk has been in the news this week with his attacks on President Trump, which he appears to have rode back from somewhat. Again, we'll talk a little bit about that and the effect on the Tesla share price. UK economic data this week, nothing much to smile about here.
Do we have to talk about that one?
I'm afraid we do, sir, along with the spending review, which was pretty much long on rhetoric and short on detail of how they're going to spend it, or basically raise the taxes to pay for it.
Yeah.
And also look at the recent numbers from Broadcom, which obviously we missed out on last week because they released after we'd recorded the podcast. This week's numbers from Crest Nicholson and Bellway, what they tell us about the UK housing market. We'll also talk about Tesco's first quarter numbers and what they tell us about the UK economy. And they're a fairly decent set of numbers, all told, with the Tesco share price up just over 2% today. Talk a bit about Rolls-Royce and the approval, finally, of single modular reactors, but there was also a little bit of a side issue with respect to Sizewell C. I mean, why they're spending 14 billion quid on a dirty great big reactor that's not going to be finished before 2040, God only knows. But again, that's a story for another podcast. More problems for Boeing in the wake of today's tragic crash in India and one of its 787 Dreamliners. This isn't one of the 737 MAX 8s. This is one of the 787 Dreamliners. So Boeing shares down. And obviously we'll also we'll look ahead, obviously, at what's coming up over the course of the next 7 days with respect to central banks. But before we get into all of that, after all that chatter on my part, haven't really given you a look in word-wise. We've got to do the disclaimer now, so you've got to listen to me for a little bit longer. Anyway, so disclaimer time. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 0.8% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Have you had a chat with your compliance about making that a little bit shorter in terms of sentencing?
No, but given the way you were rambling on there, I probably should have done it just now. I might be able to get a word in edgeways in this podcast finally.
Anyway, over to you, Michael. Let's start this week with Elon Musk and his attacks on President Trump, which he appears to have rode back from somewhat. Shareholder pressure?
Either shareholder pressure or a lawyer somewhere giving him a tap on the shoulder, I would imagine, given the conceit that he seemed to show a little bit earlier on in the week. I guess you could probably call this the most inevitable breakup ever. I mean, I think we probably sat here a lot earlier in the year saying, Trump and Musk, two quite egotistical billionaires trying to work together, it's only really going to end in tears. And so it seems to have happened. But I think when you sort of cut the noise away a little bit, it is still very much a situation where, although maybe Trump and Musk aren't going to be working quite as closely together from a political perspective, they do still need each other. And obviously one of the main ways that they need each other is SpaceX, which is an integral part of the US's national security infrastructure and apparatus. So, yeah, I think it's inevitable that they were going to have this falling out, but also somewhat inevitable that they both know they need to have at least a working relationship over the next 3 years or so.
Yeah, I mean, I looked at the reaction of the Tesla share price, and obviously there was a big sell-off in the wake of the initial comments. We've rebounded somewhat since then, and ultimately, I think you're right. I mean, basically, they do both need each other, and I think any sort of war of words, the only real winner is probably going to be the president, because ultimately he holds the chains of office. But having said that, Musk is also feeling the pressure with respect to lawsuits as well from disgruntled customers. So good luck with that, by the way. I mean, basically, at the end of the day, just because your Tesla's been vandalized, that's no reason for a lawsuit against the owner, surely. There's nothing mechanically wrong with it.
That does seem a little bit far-fetched, to be completely honest. But this is America, where they like to sue everyone for anything. So I guess we probably shouldn't be surprised. But like you said,
France.
this is happening in France, is it?
Yeah, some Tesco car owners are basically suing Tesla because of the right-wing views of their CEO, because apparently that's a crime.
I mean, I'm not a French legal system expert, but that does seem rather far-fetched, to say the least. But yeah, as you were saying, in terms of the Tesla stock, I mean, we've recovered pretty well off the lows, which you would expect. I mean, obviously you wouldn't expect us to have reclaimed those pre-falling out levels just yet, because there is a little bit more risk involved with the stock than there would have been this time last week. But nonetheless, I think the buy the dip mentality there was expected.
It also doesn't change the fundamentals behind Tesla's business model, and that is electric cars are becoming a much more competitive market. Tesla had first mover advantage, doesn't have that anymore. So
and whether Musk is best mates with the president, or even whether Musk is running the firm or not, doesn't really change that, to be completely honest.
No. So it's almost background noise. But having said that, we've seen a fairly decent rebound from the March lows. We've drifted off the May highs, and we're trading around about $320. So I would suggest it's much ado about nothing. Sort of a little speed hump, if you like.
Yeah, sold a few newspapers in the meantime with all the funny headlines that were written, though.
Okay, so let's talk about the UK data, and then we'll move on to the story that basically I've got a bee in my bonnet about this week, and that essentially is
just one.
Just the one. I'm writing an article on it, but we'll go into detail. The UK data this week: the spending review, unemployment at a 4-year high, 4.6%. April contraction of 0.3%. It's not difficult to see that one coming. And you talked about it, so the floor is yours.
I mean, I think the UK data this week has just been utterly grim, to be completely honest with you. Unemployment, as you said, up to 4.6%, new high since the middle of 2021, and I think it's clearly going to go higher. Certainly, when you look at that's April data, when you look at the more timely metrics for May that come from HMRC, payroll employment fell by 109,000 in May. To put that into a bit of context, that is the biggest 1-month decline in that employment metric since May of 2020, when there was a small thing called COVID ruining the UK economy. So the labour market is in very, very poor health indeed, and I think weakening a lot more rapidly than had been expected. But frankly, when you raise the cost of employment, less people are going to be employed. I don't think that's a particularly complex formula or equation to get your head around.
Well, apparently
apparently it is for the powers that be. But then, as you said, obviously the GDP data that we had this morning, obviously caveats around it being a monthly number, so it is a little bit more volatile than we perhaps like. But the economy contracting by 0.3% in the month of April, a lot of the factors that underpinned growth in Q1 are now acting as a drag, is effectively what's happening here. That's not just in terms of trade. Obviously, we had this huge surge in exports to the United States in Q1 as everyone tried to get ahead of tariffs. Well, in April, we saw exports to the US fall by their most on record because all that tariff front running had been done.
But we knew that would happen, right?
Yeah, absolutely. And we also knew that a lot of activity had been pulled forward into Q1 as well. Things like house purchases, car purchases, all this kind of stuff ahead of the various tax changes. But yeah, I think for me, that April GDP number is a soft figure, clearly, and probably the start of a very soft Q2, given where risks to the outlook tilt. And certainly when you put that labour market data on top of it.
Yeah, no, we had the spending review, obviously, yesterday, which I think was pretty much a wish list of what
It was
the Labour
completely
government.
and utterly pointless, I think.
Well, why?
As you said, well, as you said earlier, there's all these spending commitments and list of things that they want to spend money on, but we all know the fiscal situation is so tight that no one's entirely sure how they're going to actually pay for it. I think it was very long on political spin and very short on actual meat and any detail.
And yet bond markets seem utterly unfazed by it. And yet the fact remains an awful lot of different economic wonks, if you like, have suggested government spending is likely to go beyond 38% of GDP to 44.6% of GDP by the end of the Parliament if all of these measures are enacted, which essentially means that the Chancellor needs to do one of two things: cut spending or raise taxes further.
Yeah, and I think it's inevitable that we're probably going to end up having to do both of those things. Certainly, when you consider how hamstrung the government is by its fiscal rules, which frankly they lack the credibility that they need to change those rules. It is a case of we're just sort of stuck in this never-ending cycle of ever decreasing government spending and ever increasing tax burdens. Now, clearly, they've box themselves into a little bit of a corner when it comes to which taxes they can actually raise with this whole we're not going to raise taxes on working people business. But nevertheless, I think they're going to have to be, well, they've got no option really other than to try and raise revenue further in order to balance the proverbial books.
Right. Well, in response to all of that, the pound is actually higher against the dollar. And I got a question from Bobby on X, who's basically said to me, and I will quote: "GDP down, employment down, CPI up. How much higher can cable continue to rise?" Well, this isn't really a cable question. It's not a pound question. It's a dollar weakness question.
Yeah.
And the pound is weaker, but it's weaker against the euro. The dollar against the dollar, I think there's further upside in play here. I mean, what are your thoughts on it?
I think it's very well. We actually had a little discussion about this a moment ago. I think there's very few, if any, market participants who are sat out there bidding up cable going, this is because we're massively bullish on the UK economy. It is purely a weaker dollar story, and the dollar index, for all its flaws, is trading at about a 3-year low as we record this podcast. And that's as another bout of this sell America trade comes in on the back of some more tariff comment from President Trump overnight. So I think if
What
the
did he
market...
say?
Well, this was an interesting one because what he actually said was, in a week or two, we will write down a number in terms of a tariff, and people can take it or leave it if they want to do business with the US. Now, that's not new. Trump's been saying that since the middle of April, that he's just going to write down a number and people can take it or leave it. So it does feel like a little bit of an overreaction to that. But if the base case is that, as mine is, that the dollar will just sort of drift lower slowly but surely over the next few months, then naturally that's going to drag cable higher with it, no matter what the UK economy is doing, really. I think that the interesting question is, what will the pound's relative performance be compared to other G10 peers like the euro or the yen?
Yeah, and I think that's really the key takeaway from this. I'm looking at my cable chart, Bobby, and basically since December last year, the highs have been getting higher, lows have been getting higher. Since we broke above 134.30, which was the April peaks, we haven't been below that. So for me, while we remain above that 134 2030 area, then for me the line of least resistance is 138, and the highs that we saw in 2022, that essentially for me is the key barrier. So in this case, in pure technical analysis parlance, the trend is your friend, and until such times as we drop below 134, I think the pound can continue to move higher. Certainly that's what I'm banking on, given my trip to the States in August, September.
I was going to say, you may be talking your own book slightly.
Of course I'm talking my own book. Why wouldn't I be talking my own book? That's what traders do, right? Until the facts change, and then you do a reverse ferret, and 134 is my line in the sand in terms of the uptrend.
Yeah, no, but I do make you right on that one, to be completely honest. I think it does feel as if we're sort of shifting into an environment where we are going to see the dollar continuing to weaken, Cable is up north of 136, and as you said, been north of that 134 mark for a while now. The euro pushing up above its prior year-to-date highs around 115.75. So it does sort of feel as if the momentum behind that bearish dollar move is gaining a bit of pace.
Yeah, as 116 dollar yen potentially could go quite a bit lower as well. And I think a certain element of that is obviously what we're seeing with respect to the US economy. PPI numbers out earlier today were weaker than expected, which was actually quite surprising for me, input prices. But weekly jobless claims and continuing claims, which is obviously your favourite number, went up to 1.95 million.
Yeah, it might not be my favourite number given the message we're getting from it. New cycle high there in that number.
Rate cuts from the Fed.
Well, I don't think it will. This is the issue. I don't think that this is going to really encourage the Fed to quicken up the pace of easing or bring forward that next cut. I mean, the market is now pricing effectively fully pricing the next cut for September, 96% chance. I think the issue is, as you said, CPI was softer, PPI was softer, fine. But we're all just sat here going, well, the next one must be hot. Because the effect of tariffs is going to have to show up at some point. So is it a case of, okay, it hasn't shown up yet, but it's been delayed rather than completely averted? I think they will be somewhat concerned about what we're seeing in terms of the labour market. Obviously, non-farm payrolls last week was pretty solid, but the entire report. The jobless claims numbers are becoming more worrying. I think what's worrying is that what the jobless claims numbers imply is not necessarily that more people are being laid off, because initial claims are relatively steady, but it's taking longer for people to get back into employment. So we've got this sort of inertia in the labour market where firing is very slow, but hiring is also relatively slow. Everything's just kind of in this sort of frozen mode at this moment in time. So I don't think the Fed are going to be pushed into action. I don't think they're going to really change their message next week, but certainly a few chinks in the armour, so to speak, in terms of the jobs market.
So essentially a reluctance to fire, but also a reluctance to hire. And that's sort of borne out in the JOLTS numbers, the reluctance to hire because of the number of vacancies.
Yeah.
And that's a throwback from COVID, isn't it?
Yeah, I was going to say, I mean, we spoke, I think it was probably even before COVID, where you had this idea of labour hoarding, where skills are in such short supply, and it's so hard to hire people that companies would rather keep hold of their employees and maybe reduce hours or something like that for as long as they possibly can, rather than making those sort of preemptive layoffs that we may have seen in prior economic cycles. And now, of course, the risk with that is it's all well and good and things are relatively stable, and if you achieve a soft landing, that works fine. The risk is that when the labour market then does start to crack, it ends up cracking very, very quickly and quite aggressively.
Yeah, so essentially it's a slow burning fuse, essentially. But when it does blow, it'll blow it'll blow quite quickly.
Yeah, potentially.
Okay, so I think we're still talking about the US. Let's quickly look at Broadcom's numbers. They were fairly decent on the back of a record quarter. $15 billion Q2 revenue. Upgraded their guidance for Q3. Yeah, the shares fell. I mean, they're sort of retesting those peaks now, but basically AI revenue helping to deliver strong returns. Q3 Broadcom estimates it will get 15.8 billion in revenue from the 15 billion that it caught in Q2, and its VMware also had a strong quarter as well. But semiconductors, chipsets help over to deliver 56% of its revenues. So it's got a fairly balanced, well-structured business there going on, with 44% coming from infrastructure and VMware.
Yeah, absolutely. And I think that's one of the things to like about Broadcom is that they do have a very well-structured business. It's not kind of all in on AI. There are various other bits and bobs going on there. The earnings report itself was pretty solid. There's not really anything to complain about in the data. Top and bottom line beats, solid guidance as well. The revenue beat was only by a whisker, but a beat is a beat. We can't be too picky. I guess it may just be a case of the stock having effectively priced in all the good news in advance of the earnings number, and they're just just not being enough to push it higher.
What did you make of Apple's Worldwide Developer Conference? I've got to say, I was very underwhelmed by it.
Well, yeah, I mean, I'm obviously not the most technologically literate man that you're ever going to meet, as you're well aware. But I mean, all they seem to have done is change the 18 to a 26 in terms of the name of the software and make an iPhone harder to read with this whole liquid glass nonsense. I mean, it doesn't feel like there's particularly much by way of fresh thinking or new ideas or innovation going on there, in all honesty.
Yeah, it's getting left behind on artificial intelligence. And I'm looking at the share price since those record highs that we saw all the way back in December. And pretty much for the last month or so, the share price has done very little. It's traded between $190 and $210. It's traded sideways. So it's little, it's trading in a little bit of a no man's land.
And I think that's pretty logical, to be honest. I mean, if you think about the factors that influence the stock, obviously demand for things like iPhones and Macs and iPads, that's always going to be there to a degree, even if the sort of product refresh cycle in terms of how often people are buying a new phone is much longer now than it was before. The AI story, they are miles behind the curve. For whatever reason, they just don't seem to be able to get that right. And actually, I think one of the things that came out of WWDC was a partnership with OpenAI of some sort, which is almost Apple turning around and admitting that actually they're failing so much that they need to just sort of piggyback on who would ordinarily be their competitors at this point. And then you've got the continued risk around the whole China issue and what tariffs are going to be levied on Apple products coming into the US. Of course, you've still got President Trump ringing up Tim Cook saying that he should be building stuff in the US instead. So, I can kind of understand why the market doesn't really want to take the stock anywhere in particular, right?
Why don't they just buy OpenAI? Surely that would be easier. They've got the money.
They do. Have you seen the company structure of OpenAI?
Yeah, but once you bought it,
Talk
you can
about a web
it.
of intrigue. Yeah, I'm not sure which bit of it you'd have to buy to actually get control of what you want. That might be half the problem.
Well, I suppose there is that.
But yeah, that is actually, I know we're joking around, but that might be a route that they end up having to go down, where they make maybe not OpenAI, but a significant acquisition in that space, someone like Anthropic or someone like that they have to buy just to be able to catch up with what Microsoft and Meta and all the rest of them are doing.
Yeah, well, certainly acquisitions are in the news this week. We'll come on to that in a minute. But before we do, going back to the UK economy, we had numbers from Bellway and Crest Nicholson house builders this week. And again, fairly decent quarters. But then again, that was ahead of the stamp duty changes. So perhaps, there was a little bit of what we would call front loading or buying of properties ahead of the April stamp duty changes. And certainly that does appear to be reflected in both Bellway's numbers and Crest Nicholson's numbers, even though Crest Nicholson's numbers on terms of completions were lower, their profits were higher. So, yeah, and outlook's fairly positive. Bellway reported a higher selling price of 300 and upgraded its targets for home completions to between 8.6 and 8.7k, up from 8.5. So obviously they've had a good quarter. The bigger question is whether subsequent quarters after that are anywhere near as good. And I have my doubts about that.
Yeah, I would join you in that rather doubtful mindset, to be honest. As you said, there were numerous incentives for Q1 to be a very, very good quarter in terms of home sales and home building because of the stamp duty, which has now gone back to, the threshold is now back at 325,000. So clearly it will be much, much harder for that sort of positive environment to continue. So while they might have issued optimistic guidance, I guess the difficulty now is, can they actually meet that guidance?
Sorry, what was the stamp duty threshold? Was that 125,000?
I think it's 325
I
now.
thought that was the inheritance tax threshold.
You may be right.
I'll double check that.
It is 125. Sorry, you're absolutely right.
Yeah. Tesco's solid set of numbers. Some share prices back close to the highs that we saw in early February. I'm close to decade highs, around about just below 400p. And I looked through the numbers, and there's really not an awful lot to dislike about them. I don't know whether you had a chance to look at them. Pushed their market share to 28% of the UK market. For the 13 weeks to the 24th of May, the retailer saw a 4.7% increase in like-for-like sales of 15.39 billion. UK operation, 5.1% increase. Food sales saw a strong quarter, 5.9% increase. Again, this encompasses Easter and the bank holidays at the beginning of and the bank holiday at the beginning of May. Obviously, we had warm weather as well, which obviously showed up in the recent numbers from Next and B&Q, Kingfisher B&Q. And the weak link, which was Booker in the end of year results, that also saw a decent pickup in sales. But, and there's a caveat here, this was driven by its catering business. On the other side of leisure, Best Food Logistics, which obviously funds companies like Pret a Manger and ZZ's and places like that, they saw a decline of 0.9% in like-for-like sales in that quarter. So people aren't going out to eat. They're basically spending money in the supermarkets and having beers and barbecues and what have you and eating at home.
Yeah, and I think that's an important indicator in terms of the economy more broadly, because it's potentially a sign of falling confidence. If people would rather be, or they're not comfortable to be going out and spending in bars and restaurants and all that sort of thing, they are sort of starting to tighten their belts a little bit, which I thought was an interesting little nugget within that report. The other thing that was quite interesting was they left their profit guidance unchanged for the full year. So again, although they've had, a strong few months, there's question marks over whether that performance can continue.
Yeah, and I've noticed it as well. I mean, we go to Tesco's every week on a Monday. The missus and I go to Tesco's every week. And,
to be retired, eh?
I know, tell me about it.
The rest of us in there in a scrum on a Saturday.
On Monday mornings, we go to the cafe in Tesco's, have a nice coffee with a sausage and ketchup sausage roll. Well, that's what I have. She has something different. And then we go walk around Tesco's. Basically, what I do is I label check.
Yeah.
I label check and compare them with places like Aldi, Sainsbury's, and what have you. And it's very, very competitive.
You're basically a one-man ONS at this point, doing his inflation basket.
Given the
probably doing a better job.
record.
Yeah. It's a very low bar. I wouldn't take too much credit in that one.
No, I know. But, I posted an article on my Substack last week. Do the Tesco's numbers give a better indication of the health of the UK economy than the ONS does? And I would argue it does.
Yeah, I think they're certainly going to be more accurate than the ONS numbers, that's for sure.
Just check retailers' numbers. I mean, yeah, it's more time consuming because you've got to look at companies like Next, Marks and Spencer's, B&Q, Kingfisher and Tesco's. And what was also notable was that actually fuel, like-for-like sales for fuel was down as well. So people aren't obviously driving as much. So again, that gives an indication that, the cost of living is driving a change. People are staying at home more rather than going out.
No, absolutely.
So that's Tesco's. So all in all, a good set of numbers, but there are little warning signs within those numbers that suggest that consumer discretionary is slowing. And certainly, I think as we look ahead to next week, we've got UK retail sales, which should also give us a fairly decent indication as to where we are vis-a-vis the UK consumer. I mean, because we have had a lot. We've come off the back of 4 really strong months in January, February, March, and April.
Yeah. And again, you almost akin to what we were talking about in terms of US inflation. You're sort of sat there, and especially with what the retailers are saying, going, well, this has got to roll over at some point. Is this going to be the month that it does?
Yeah, indeed. Okay, so we'll finish up with obviously the one that I've got to be in my bonnet about, amongst many other things, as you so helpfully pointed out.
Narrow it down.
AlphaWave, another UK tech, announced this week that Qualcomm are purchasing them for the very small sum, and it is a small sum, £0.4 billion, as it becomes the latest in a long line of companies to leave the London market. There was also another bid, I think Spectris. Let me see if I can find it, which I don't think they've accepted the bid yet, from a US private equity firm, Advent, of $5 billion, I think. Is that the amount?
I think so. Annoyingly, my notes have just disappeared, so I don't have it in front of me at the moment, but it wasn't particularly large.
Yeah, so it's been snapped up by Qualcomm for essentially pocket change of $2.4 billion, 183p per share, less than half the price of its 2021 IPO price, which was 420p. Now, AlphaWave is a Canadian-based company which listed here in the UK. It raised £856 million in 2021 at 410p a share, and it used the money to open a new headquarters and R&D operation in Cambridge as part of its overseas expansion. I mean, it's a semiconductor company, and yet it's trading at half the book value that it launched in. And yet you got semiconductor companies in the US trading at a premium, and here they're trading at a discount.
Yeah.
So
And
I did a little bit of digging.
go on.
2021 was a record year for IPOs here in the UK.
Hmm.
Do you know what other companies listed in the UK in 2021?
Bloody hell! Now you're testing me.
I didn't expect you. I didn't expect you to come back with an answer, because when you hear them, it's very interesting. Deliveroo,
Gone.
Darktrace,
Gone.
Wise,
Going.
Oxford Nanopore,
Gone, I assume. Or are they still
Trustpilot,
around? Yeah.
Moonpig, Dr. Martens.
Yeah.
Okay. Now, the common denominator in all of them is that all of them, bar Wise, are trading below their IPO price. Every single one. Is it any wonder people aren't launching IPOs? We've had Shine turn their nose up at an IPO here in the UK. We've had Unilever turn their nose up at an IPO for the Magnum ice cream company choosing to list in Amsterdam. What's it going to take for this government to get their heads out of their backsides and actually think there's a problem here? It's
Yeah,
not as if no one's shouting about it.
No, and we've certainly shouted about it enough to the point of exhaustion. And actually, on this note, there were some stats via Bloomberg earlier in the week that year to date, bearing in mind we're only 5.5 months into the year, the London market has already lost £25 billion in terms of market cap for companies that have either moved their listing or had bids from overseas. And also in that time period, we've had just one IPO, which is frankly pitiful, but there doesn't seem to be any desire whatsoever to do anything about it, which I think is the even bigger scandal here, is the fact that we're just, well, not we, but the powers that be are just letting this death by 1,000 cuts happen right in front of our faces. We know what's going on. We know what the issues are. We know how to solve them. There's plenty of people telling you how to solve it, but no one seems to want to listen.
No, and unfortunately, if you're expecting government to solve the problem, I think you're going to be waiting a very long time, because to a large extent, they are the architects of the problem. And it started back in the 90s when Gordon Brown implemented the abolition of tax relief on dividends. And it's really gone from there. Regulation too high, taxes too high. Is it any wonder that people don't want to list in the UK?
Yeah, and also, and again, we've spoken about this at length, but it's become self-fulfilling. We talk about one of the big issues with the London market is a lack of liquidity. We all know that's an issue. The more and more companies that leave the market, the worse liquidity is going to get. And then more people are going to carry on leaving. So, some people might say it's a bit weird we're talking about this in a week where the FTSE did very briefly trade north of the record that we saw in March. But fundamentally, this is a huge issue that is getting worse at a worrying rate of knots.
Yeah, but the FTSE 100 is not a UK index.
No.
Not really.
No,
if you look at the companies that are in it, it's very much a global index. An awful lot of the business, and you strip out retailers aside, like Marks and Spencer's, Tesco's, Sainsbury's, and what have you. They're big retailers, and they don't have a large overseas footprint, if at all. Next, again, another example. But companies like Unilever, GlaxoSmithKline, AstraZeneca, Shell, BP, Rolls-Royce, they're all big multinationals. Strip them out, and what are you left with?
Well, nothing, effectively, is your answer there.
And that's the danger. That is the danger, because we're not alone in thinking that this could get worse. BHP Billiton moved its primary listing back in the day from London to Sydney on the back of shareholder pressure. Rio Tinto has been talked about that could potentially happen as well. Shell is another case in point. Pressure is being brought to bear there that they could get a much better valuation in the US than they currently have here in the UK. If you look at their competitors like ExxonMobil and Chevron, I could go on.
Yeah, we could do probably about 4 podcasts just on this issue. To be honest, I think.
So this has become. I'm very worried. I'm very concerned about it.
Yeah, but I think we all should be. Because,
I think we all are, and I don't think people are making
one direction.
I don't think people are making enough noise about it. And you had Kemi Badenoch giving a press conference this morning, basically saying, calling out businesses for saying you need to get on board the train and basically shout about this. We've been shouting about it for the last 20 odd years, and your old government has been instrumental in undermining UK investment. I mean, what more can we do?
Well, it does make you wonder, and it's also rather hypocritical that someone who was business secretary for a year and a half doesn't realise that businesses have been talking about that. But, there we are.
Anyway,
let's clamber down from those high horses that we've got on.
It's just so frustrating, Michael. I mean, you look at the people, in power. And you think they probably haven't got half a brain cell between them.
It does not fill you with confidence, does it? Let's put it that way.
It's the politics of envy half the time.
Yeah. No, you're absolutely right.
Anyway, just take a sip. 1 second. And I'm back in the room. Right, next week, UK CPI.
Yeah. Oh, God, that's another one we've got to have a rant about, isn't it?
UK CPI, UK retail sales, Federal Reserve, Bank of England, and just a couple of earnings announcements. One from Ashtead, obviously they're leaving, and 4-year numbers from them, and AI World, which obviously is just an online version of Currys, reporting their full-year numbers as well. So what should we start with? Well, obviously, I think UK inflation. Obviously, we saw a big jump in April. I think the big question
not
is,
as big as was reported.
well, yeah, 3.5, 3.6, but they're not adjusting for that.
No, I don't quite understand the logic behind that. You know, we've admitted that we got it wrong, but we're not going to correct the mistake we made. What? Oh well, move on.
So what do we know what we're expecting? I mean, the miscalculation was 0.1%, so we're not really talking a big error here.
No, it's not a huge error. I mean, I think it just again speaks to the incompetence of the people compiling the statistics in the UK. There aren't actually any expectations for the print just yet, but you would expect, I think, inflation to either remain at this level or just continue to rise gradually over the next couple of months. I think the profile that everyone's expecting to see is a sort of hump over the spring and summer, and then that will fade away again as we move into the back end of Q3 and Q4 of this year. Obviously, a lot of focus will be on the underlying metrics, particularly the services gauge. That was well up north of 5% last time. I think that was a 9-month high, if I remember rightly. So yeah, there is going to be, they've got a thumbs up. So yeah, there's going to be a lot of focus on those underlying price metrics, but fundamentally, it's not going to change anything for the BOE next week. They will get the data on Monday, incidentally, but they'll be keeping rates on hold on Thursday. I think that's pretty much nailed on at this point.
There'll be a split though, right?
Yeah, I would expect probably 2, maybe 3 on the MPC to dissent in favour of a 25 basis point cut. Obviously, they delivered a 25 basis point cut in May, lowering bank rate to 4.25%, but then Dingra and Taylor preferred a larger 50 basis point move. So you'd expect them to be in the dovish dissent camp once again this time around. Then, of course, you've got the question over what the hell is Catherine Mann going to do? Flip a coin, roll a dice, and probably get to a vote somehow from those methods, I would guess. Either 7-2 or 6-3, but certainly the majority of the committee will be in favour of keeping bank rates steady.
Yeah, I was minded to recall that Mann's attempts to justify her decision to hold rates merely served to create more confusion, because she talked about a resilient labour market, which were at odds with the bank's regional survey, which suggested hiring was slowing quite sharply.
Yeah, I tell you, the other hawkish dissenter at the May MPC was, of course, the chief economist Hugh Pill, who about a week after that meeting gave a speech entitled "The Courage Not to Act." Well, Mr. Pill, if you look at the data, I think it's foolish rather than courage that you've displayed over the last month or so.
I think, to be fair to them, their job's not being made any easier by the Office of National Statistics.
No, I would fully agree on that.
Because the data is completely unreliable. And I know Megan Green, the external MPC member, gave a speech where they were talking about implementing some form of AI solution, which couldn't be any worse than the current setup.
It really couldn't. I mean, actually, we probably shouldn't tempt fate on that one.
So we've got inflation. Obviously, we talked about the Bank of England. Obviously, I think they'll also be mindful of the UK retail sales numbers because they're due out on Friday. So
yeah.
When we record this podcast next week, we still won't have visibility on them.
No.
But I will be surprised, and I don't know whether you share this view, that I'll be surprised if we get a positive number, because we've had 1.7, 1%, 0.4 and 1.2% this year so far. So that's 4 months of really strong gains. So May retail sales, I can't see it.
Yeah, again, no consensus for that just yet, but I would fully agree with that. I really can't imagine there being fifth strong month in a row. Seems a very tough ask, given the economic backdrop and given the various other indicators that we've already discussed. And also, if you think about, one of the reasons why the April number was so strong was because of the weather. All of these summer purchases have been pulled forward. If you've gone out and bought a barbecue when the sun came out earlier in the year, in early April, you're not going to go out and buy a barbecue again in the month of May. To use a relatively crude example, but I think that is going to act as a bit of a drag on the figures when it comes out next Friday.
Yeah, I mean, when you've got to absorb all those utility bill increases at the same time as spending money on booze and food and barbecues,
Yeah.
you've got to think, May, something's got to give, and
Yeah.
maybe you keep your hands in your pocket.
Yeah, at some stage, this pace is unsustainable, and it will have to take a bit of a breather. Which it probably isn't too worrying.
No.
If you have 4 very strong months and then a blip, it's not a case of we need to start signalling that the end is nigh. But it's just a sort of pause, I suppose.
But we are also talking about ONS data, so how reliable is it really?
Yeah, that's very true. Like
Let's
we
keep
said
an
earlier,
eye out for revisions, shall we?
Yeah, well, like we said earlier, the retail earnings are probably a much better gauge.
Absolutely. Okay, let's talk Fed. Federal Reserve. No changes expected. We got slightly softer inflation readings this week. Continuing claims, 1.95 million. Highest, I think highest in quite some time. You could probably give slightly more detail on that. But jobless claims are heading in the wrong direction.
They are. As we said earlier, I'm not entirely sure that it's going to change the Fed's mind particularly much. I think the June FOMC is very much going to be a placeholder. They are staying on the sidelines for the time being, waiting for clarity on the outlook, waiting to see how tariffs are shifting the balance of risks around the dual mandate. The one thing we do get from the Fed next week, and I would imagine policymakers are probably sitting there thinking this is more of an annoyance than anything else, is their quarterly summary of economic projection. Now, trying to forecast the economy at this moment in time is a bit of a mug's game, to be honest, because if things are changing by the minute. You would imagine that compared to March, they nudge inflation expectations higher and GDP expectations lower. I mean, we're trying to forecast a forecast here, which is almost impossible. And of course, you get the latest dot plot as well. Currently, that points to two 25 basis point cuts this year. It would only take 2 policymakers moving their dot higher for that to signal 1 25 basis point cut, which is obviously a more hawkish path than the market is currently pricing. So they may be areas of interest, but as for the statement and as for Chair Powell, I think they're going to try and be as non-committal as they possibly can be.
I think recent comments from some Fed officials need to be taken more seriously than others. And I think, if you're looking for a central bank that's perhaps looking to have a discussion about a rate cut, the place to look is the dovish members. And I was struck by something that Chicago Fed member Austin Goolsbee said in recent comments. He tends to lean more dovish, or he has in the past.
He's almost falling over. He's so far towards the dovish side, I think.
Okay, well, he said while the slowdown in April inflation was welcome, he would prefer to see a lot more like it before considering further cuts. So
which is very telling.
That tells me an awful lot.
Yeah, no, you're absolutely right. When even the doves on the committee are not really considering doing anything, I think that speaks volumes about where the committee is at large.
Yeah, he went on to say the Fed will want to see what happens at the end of the 90-day pause in July, when it hopes the picture will become clearer on the prices front.
Well,
so
good luck with that.
If Trump wants a rate cut, wrap this tariff nonsense up.
Yeah, the one that actually just on that, because for those who are unaware, Trump has said 2 or 3 times this week actually that the Fed should deliver a 100 basis point cut immediately. The weird one was when he talked about how brilliant the jobs report was and then said that they need to do a 100 basis point cut. I'm like, this is not how it works, mate. But he is starting to sort of say the quiet part out loud, which is that the reason he wants a 100 basis point cut is because it would make it so much cheaper for the US to refinance its debt, which is true, but it is also a very worrying further blurring of the lines around monetary policy independence.
Yeah, but rate cuts won't deliver that. As the Bank of England has found out by the virtue of the fact it's cut rates quite a lot since August, and actually real rates are higher, or gilt yields are higher.
Do you want to try and explain that one too?
Well, I've been saying it in every podcast pretty much since we started these, Michael. So maybe if you say it long enough, it'll sink in. I don't know. Anyway, let's finish off with two reports next week. We're starting to come to the dying embers of earnings season. Ashted Group, full year numbers. Again, one of the companies which announced it would be moving its primary listing to the US at the end of last year, and it's unlikely to be the last. It's a UK business, right? But it does 80% of its business in the US. So I think you can probably understand why it wants to move, because ultimately I think it could get a much better valuation.
Yeah, no, and yeah, it makes a hell of a lot of sense why they want to move, not only from a valuation perspective, but also, as you said, the vast majority of their business is based in the States, and certainly right now there is not that much by way of incentive to keep your listing here in London.
No, indeed. On the outlook, the company said it was trading in line with expectations when it delivered its 9-month numbers, year-to-date numbers, and expects to deliver group rental revenue growth of between 3 to 5%. So that's they're reporting on the 17th. And we've got AOL World on the 18th, and it was a big pandemic winner. Since then, it hasn't really done that well, and ultimately came down, crashing down to earth with a bump, sinking to as low as 35p at one point after peaking at 400p,
which is quite
during
the fall.
COVID. Frasers Group has got a stake in it. Who has? Which company does Frasers Group not have a stake in the retail sector?
They've got their fingers in so many pies, haven't they?
No, 25%. So 29, and they sort of have to start thinking about a takeover.
Yeah.
We've seen a fairly decent recovery, but they're only back below their 2024 peaks of 120p. So it's reasonable to ask, I think, what happens next with a company that competes with the likes of Currys, and by and large, according to its most recent filing, is trading ahead of expectations.
Yeah, it's tough one to imagine much more upside there, really, isn't it?
Yeah, AOL says its adjusted pre-tax profit is expected to be at the top end of the 39 to 44 million pound range when it reports on the 18th of June. So again, that's a nice little window into the UK consumer
Retail
and the appetite for
absolutely
white goods and other electronic
those big
devices.
ticket purchases which you don't just go out and buy on a whim.
Indeed. Okay, I think that's it for this week, Michael. Certainly a fairly broad discussion. Is there anything else you want to have a chat about, get off your chest? Or...
Oh, there's plenty I want to get off my chest, but none of it's suitable for a podcast, so we should probably leave it there.
Well, we'll discuss it. We'll discuss it over a pint later, shall we?
That's a much better idea.
Yeah, there'll be no censorship then. Okie dokie. All right. Well, thank you very much for listening, guys. As I say, if there are any questions or you want us to answer any sort of questions on this podcast, just drop us a line via X. We'll always try to give you an honest answer, even if it's not the answer that you want to hear. But ultimately, that's the whole point of these podcasts, to try and inform and educate. So that's it for this week. Thanks very much again for listening, and see you same time, same place next week.
Bye for now.